I think when you retire, you should wake up every day and be happy. And you know, what are we doing today? You can do whatever the heck you want to do if you got a good plan together. But one of you may want to travel, one of you may not. So, that could be a conflict, right? But you're going to have your go-go years. You're going to be healthier as you retire, you're mentally, physically. Then you're going to slow down a little bit. So you just got to do stages of planning, whether that's you need more money the first 10 years in retirement, you need less money down the road.
Welcome to Redefine Retirement with Ryan Wheless, powered by Ally Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Welcome back to Redefine Retirement with Ryan Wheless. Today I'm joined by Garry Thurman, owner and CEO of Guardian Investment Advisors. With nearly 25 years of experience, Garry specialized in modern retirement strategies, including Roth conversions, navigating tax changes like the One Big Beautiful Bill, and protecting legacies amidst new income retirement planning tools, also auto enrollment and Social Security complexities. He's also a dear friend of mine. Welcome, Garry, to the show. Welcome, Garry, to the podcast.
Ryan, buddy, it's always an honor to be on the podcast with you and just to hang out with you in general. I'm stoked about this.
So Wilson and I Joe Wilson, a good friend of Garry and I, did this completely unscripted the other day, and it worked out pretty well. So we're going to try to do some of the same stuff today, man.
Love it.
So what's going on at Guardian, bud? What's happened today?
I tell you, Ryan, we are, I'm sure just like you, we are really working with a lot of folks right now, especially since this big, beautiful bill got passed. A lot of confusion going on out there about taxes. And we're really trying to take advantage of this window of opportunity that we have for clients right now to get some of that taxable money over to tax-free money. I'd say that's the main thing we're doing right now for our clients. But of course, we're always, looking for income sources for folks, making sure they optimize Social Security benefits. And a big topic for us right now, Ryan, is long-term care. I think people are starting to get a little more aware that we are living longer now. There's a big opportunity that they might get sick and need some care. So that's our three biggest topics right now.
So let's spend a little bit of time on the One Big Beautiful Bill, and let's talk about that. And one of the things that really got me, by the way, is I don't know if you remember or not, or if you saw the email, but the Social Security Administration jumped the gun and sent out a mass email saying people would no longer pay tax on their Social Security benefits. And, the next day or a day later or two, it came out that email was not accurate and to disregard the information. But Trump ran on cutting taxes on Social Security or eliminating them on Social Security. Does the Big Beautiful Bill do that? Does it help reduce taxation on Social Security at all?
Yes. The easy answer is yes for most folks. For 88% of folks out there, with the Big Beautiful Bill, it's not tax free. I want people to understand that there are still taxes on your Social Security benefits, but what they have done is gave you a deduction, a $6,000 deduction for a single person, a $12,000 deduction for a married couple. And they did change the limits, the income limit. So you can get these deductions, and that's why they're estimating right now about 88% of people that are actually on Social Security will not pay taxes on that Social Security benefit. But it's not because it's tax-free, Ryan. It's because of the deductions that they've added. For someone like my mother, Ryan, it's a beautiful thing. My mother lives on Social Security. That's her only source of income. And so, in my opinion, she just got a raise. So I think it's a good thing. But did it eliminate the taxes? No. And they only put a Band-Aid on it. As of right now, they're saying that's going to go through 2028. So we'll see what happens after that. But hey, at least these folks are getting that deduction now. So that is going to help out a little bit.
Yeah, I do agree with that, Garry. And what's really interesting to me too is you and I both do a lot of advanced tax planning for our clients, which we know other firms don't do for a lot of reasons we can get into. But we're looking at right now a married couple with these new age 65 or over with these new deductions can have nearly $146,000 of income in a year's time, and be in the 12% tax bracket. That's pretty darn good, bro.
I think it's absolutely fabulous. I do, because I mean, you can make up to 150,000 now and still get the deduction as a married couple. And what got me, up to 75,000 as a single person and get this $6,000 deduction. So I think it's a great thing, for our system. I think it's a great thing for our seniors out there that are taking Social Security. I wish it would last a little longer. Yes, it's just till 2028, but hey, that gives you 25, 26, 27, 28 of some good deductions on those Social Security benefits.
Yeah, let's spend some time talking about what the window is to beyond Social Security benefits. And you guys, are you fans of Roth IRA conversions? I'm asking a question I already know the answer to, by the way.
Yeah,
are you guys fans of Roth IRA conversions? And what type of opportunities for somebody that say makes that actually spends $100,000 a year of income in retirement? What kind of opportunities are here today, or for the next 4 years at least, until 2028, to do Roth conversions?
Yeah, you just said it. I mean, Ryan, you and I have been talking about, we've been in the third lowest tax bracket we've ever been in for a few years now, which is great. Well, that just got extended for a few more years. And so I have been sitting here in the studio, out on the TV set, on my radio show. All we're talking about is take advantage of this golden opportunity that you have for the next 3 to 4 years to take some of that taxable money and convert it over to tax-free Roth IRA, tax conversions, Roth conversions. And I think what a lot of people, we had a big, beautiful bill lunch and learn the other day here at our office for our clients. We had 40-ish people show up. It was great. So many people are still confused, Ryan, about purchasing a Roth IRA because there's limits on how much you can do and how much you can actually make in income versus a Roth conversion. A lot of people are still confused that you can take as much as your IRA money as you want to and do a Roth conversion. You don't have to do it in 1 year. We can do it in 2, 3, 4, 5 years. What we are trying to do, because of this window of opportunity we got with the big, beautiful bill, we're doing our best to keep people in the same tax bracket. Now, that might not always work, but that's kind of what we're looking at doing. As a matter of fact, right before I jumped on here with you, Tim and Bobby were sitting with a client, one of our newer clients, and they've got a couple $1 million, and they are going to do their best to convert about half of that over the next 4 years. And the clients were all about it because we all feel that taxes are going to go up at some point. We don't know when, but what we do know we know for now we got another 4 years that we can have this low tax bracket and pay taxes on those seeds versus that big harvest. So Roth conversions are the number one topic at Guardian Investment Advisors in Chattanooga, Tennessee.
Yeah, they're a big topic here for us at Allied Wealth too. And it's a conversation that we have ongoing. One of the things that we spend a lot of time planning for, Gary, is the death of a spouse. And sadly, every retiree out there is going to face that at some point in time. Let's spend some time talking about the benefits of tax planning and helping the surviving spouse, whether it be a widow or widower, avoid what we know to be one of the biggest tax penalties hidden in the tax code when one spouse dies in a household.
Well, right off the bat, you go from the best tax bracket to the worst. You go from, joint tax bracket to the single tax bracket. So your taxes are going to go up that following year right off the bat. Let me tell you something I've seen. I've been doing this a long time. And, Roth conversions have not always been a hot topic. But what I've unfortunately seen is all these folks go into retirement and they have all these IRAs, 401ks, 403bs, and they don't actually need to pull income from it. They don't need to pull income from it. But all of a sudden, they got to start taking those RMDs. Now, all of a sudden, they got this huge tax burden. Well, that surviving spouse is going to have that same tax burden unless somebody starts doing some planning first. Now, of course, they can do, some QCDs and different things like that. But the surviving spouse automatically is in a bad spot because they go to that single tax bracket. Plus, they're going to lose one of the Social Security benefits. So there's a lot of things that the surviving spouse. I love this topic because this is why we love life insurance. I mean, I absolutely love life insurance. We don't do a ton of it, but if you can have a $1 million life insurance policy for your surviving spouse and there's some taxes to be paid, well, they've got the money to pay them. But I think your question was, how does it hurt the surviving spouse? Well, one, you go into the worst tax bracket. And two, if you've not done some Roth conversions, you're still going to have to pay all those large RMDs. Even if you're the surviving spouse, you don't have a choice. You've got to pay the RMDs. And then God forbid on that second person passing, the children now or the grandchildren have to take it out in over a 10-year period of time. So Uncle Sam's going to get his part. But man, we have a window of opportunity right now to take some of that part away from him. Go ahead and pay some taxes now. So when that spouse passes away, you get a lot of benefits tax free.
Yeah. And that's, it really is interesting because a lot of people think that the surviving spouse, they'll slow down and they won't spend as much money, but that's not the way it works. The surviving spouse is usually the lady, by the way, the wife.
Yeah.
She doesn't want to cook dinner for one person.
No.
She doesn't want to be at home alone, right? So she tends to travel more, go out more, do more, eat out more. And the expenditures actually stay the same. And what oftentimes we see is they're paying more income tax on a lesser amount of income than they were paying on more income when the husband was still alive because they're in those joint filer tax brackets.
Ryan, I told you we had that lunch and learn for clients of ours. And one of my favorite clients of all time, I'll just say Jim and Kathy. I'll use first names. I just love these people. Jim unfortunately passed a couple of years ago, and it's been a rough road for Kathy. But I told her, I said, don't stay at home. I mean, get out, mix and mingle, have some fun, join a church group, volunteer at the Red Cross, whatever the case may be. And she is really so active now. I mean, you still feel sorry. I mean, I know she still misses Jim very, very much, but she's out there. Like you just said, she's going out to dinner. She's spending more time with her kids and her grandkids. So she's actually spending more money than she was when Jim was still alive. And she's now in a single tax bracket. So you're correct. I think you have to plan. And that's why one of the things we love to do is set up joint incomes for our couples, making sure that both spouses never run out of money, because I think that's going to be essential, especially when you got to start paying more taxes.
Well, the interesting thing, too, I think I want folks to take away from this, Gary, that they can actually use and apply to their situation, is the fact that you've got 4 years to plan. You've got 4 years to pay taxes at lower tax rates, okay, and move money from IRA dollars over to Roth IRA dollars. Now, what that does, folks, is when one of you dies and the surviving spouse is there, the required mandatory distributions that you're forced to take out of your retirement accounts could be substantially less. And the reason why is years ago, like now, we converted all those IRA dollars to Roth IRA dollars. And those Roth IRA dollars are not subject to RMD requirements, and nor are they ever taxed again, right? So that's a big opportunity. I think that's what Gary and I really were speaking to here. Another thing, Gary, that we had Ed Slott on recently, and Ed's just the guy's forgotten more than most people ever know about financial planning and taxes and that sort of thing. But Ed actually had a really interesting statement that he made to me, and I was surprised. He said, Ryan, when a spouse dies, we recommend the surviving spouse convert every single dollar in that year to Roth IRA, every dollar. So if they leave $1 million IRA behind, convert it to Roth, all of it, because they're doing so in a lower tax bracket. And that was an interesting philosophy. And Ed, is a CPA and has forgotten more about taxes than most will ever know. But I thought that was interesting.
So we were in with a couple not too long ago. They've done well, Ryan. They've done very well. And we were kind of talking about the same thing. And the guy's like, wait a minute. You want me to take X amount of dollars and do a Roth conversion all at once? Or are we going to spread it out over the next few years? I said, we'll do whatever you want. Mathematically, it makes sense to do it all right now. It makes so much sense to do it all right now, especially for that surviving spouse. Because I'm going to go ahead and say it, most likely it's going to be the lady. They outlive us guys for many reasons, but that will give her tax-free money for the rest of her life, no matter how long she lives. And that's a beautiful thing to not have to pay those high taxes anymore.
Yeah, it really is. And my friend Tom Hagnam, also on the podcast recently, his philosophy is to spend all your IRA money you want to. Spend it all. Do not leave your kids an IRA, or don't leave your spouse an IRA if you don't want to.
Right.
Leave them life insurance, because the life insurance is 100% tax free and then never pay tax again on it, which ultimately eliminates the government's plan for your retirement savings.
Yeah, Tom just did a podcast not too long ago, and I listened to it. And one of the things he talked about was the life insurance. He said exactly that, and I was like, "Wow, that is such great information." Spend all of your taxable money, spend it all, buy some life insurance. People don't realize how inexpensive life insurance is because you can take pennies on the dollar and leave your family in such a better place, especially your children or grandchildren or your favorite charity. You can give them a chunk of tax-free money. I've got a grandbaby now, as you know, Ryan. And one of the first things I did when that little guy was born was I increased my life insurance just for him because there is no telling what he is going to see in taxes throughout his life. He's just over 1 year old now. There's just no telling what kind of money that young man is going to have to pay in taxes. So I thought G-Daddy, which is what I hope he calls me, he's G-Daddy. I'm going to leave as much tax-free money in a bucket for this young man as I can so he don't have that burden on him of paying high taxes when I pass away.
Yeah, it's helpful, but the life insurance is so overlooked in a lot of ways. And, when you leave money in an IRA now going outside the spouse, right, you move it to leaving it to a kid. I mean, the IRA rules have changed dramatically with the Secure Act, right? Which I call Setting Americans Up for Taxation Act, because now beneficiaries that are not your spouse are required to liquidate IRA accounts over a 10-year period. And let's just say you leave them back a $2 million account. Well, if they're liquidating that over 2 or 10 years, and it's growing at 8% a year, I think the amount they have to pull out each year is around $250,000.
Yeah.
Now,
that goes on top of their income too. If they've got a great job.
Yeah. If you put them through school, they went to, UT, went to Tennessee, wherever.
Right.
And they get out and they've got a great professional job. They're making good money. And God forbid if they're not married in the joint filer brackets, they're single. You just dumped a massive amount of income on their tax return.
Yeah.
And 43% currently, 38% of your IRA currently will wind up going to the government. Well, what if you took that 38%, just that alone, and bought life insurance with it?
There you go.
Right?
Why not?
Yeah, why not? I mean, it's just that there's a lot of stuff out there. And Gary, I think that's why I know you're passionate about money across America, and I'm passionate about this podcast, Redefine Retirement, because I think people are aware these tools exist, like life insurance, but I'm not quite sure they understand how to use them and the implications.
They don't. I think it's a lack of education on how to use them. And I think it's a lack of knowing that these companies have gotten so much better than they were even 5, 10, 15 years ago, Ryan. We can take someone that's in their early 70s and get them a really good life insurance policy now, even if they have some medical issues going on. Now, if it's something major, then of course not. But they have companies now that will take care of you. And I think people are just a little bit nervous about, well, I'm not going to qualify. Why are we having this qualify? I've got high blood pressure. Well, doesn't most of America. Yeah. So, I mean, that's not going to, will it impact your rates a little bit? Had a guy in here how old was he? 62 years old. He wanted to buy a large life insurance policy. You know why? His term policy was running out that he had for 30 years. Of course, their rates were going crazy on him. I said, let's do some shopping around. And we got him a much better rate than what they were offering. But he didn't tell me something. He has sleep apnea. He didn't tell me that, so of course they raised his rates a little bit. But the point was, I told him, I said, this is still very inexpensive because look at the chunk of money you're leaving to your spouse and your children and grandchildren if you do pass away. And just had to kind of educate him on why are we buying life insurance? I wish I could sell more life insurance. I wish people, were more in tune and liked it a little better. Maybe that's my fault. I need to market it better. But I think life insurance is a beautiful tool if it's used the right way. I know you and I both know there's a lot of people out there that missell life insurance, and they talk about these big numbers and stuff.
Oh, you see the guys on TikTok, right? He puts I bought the life insurance policy and I borrowed $100,000 the next day, and I went and bought a Lamborghini with it, and now I ripped the Lamborghini out.
Yeah,
Guys, that's malarkey. And that's not the
it
proper use of
is.
life insurance. And it really does, I think, it a disservice.
Well, and it gives a lot of us a bad name. I mean, you got to work with a fiduciary advisor that's going to do the right thing for you. And we're talking about income and surviving spouses. And Ryan, another big topic for me, and a lot of advisors don't even like talking about this, is I like talking about Social Security because I think there's the right time and the wrong time to turn on your Social Security. As a matter of fact, I think you and I both know 97%, I think it's 97 or 96%. Our good buddy Chance always talks about this. How 96% of people turn the Social Security on at the wrong time, and there's $4 trillion being left on the table. And it's just because people are doing what their uncle did or they're doing what their neighbor did. They're not sitting down with a fiduciary advisor like you and going, hey, when should I optimize my Social Security benefits? This is a big, big deal for your surviving spouse, especially if you're the breadwinner of the family. All of this stuff all ties in together, but you got to think not only about yourself, you got to think about your spouse, your children, your grandchildren, and whomever you're leaving this money to.
Yeah, the Social Security conversation is interesting. I had Mary Beth Franklin on the podcast, who has forgotten more about Social Security than Ed Slotts knows about taxes, and so, interestingly enough, she was talking about how the national average Social Security check in America is around $1,600.
Mm-hmm.
Yet, if you look at full retirement age benefits today, on average, they're around almost $2,800. And if you go out to age 70 benefits, they're closer to $4,000. Yet the average check in America is $1,600. And our friend Chance is right. There's gazillions of dollars being left on the table because of lack of planning. And I think people, Gary, get that because they're scared. They've lost confidence in the government's finances. They don't think that the Social Security income is going to be there for them. They're going to go away. I've got a guy who's worked on an oil rig. He's kind of a hard guy from Louisiana, and has been a roughneck his whole life out at sea on a rig. Great guy, but man, we literally got into an argument, and he's a client of mine. But we got into an argument about Social Security, very heated one, by the way. And his wife was in the room with us, and he was 62, or he just turned 62 to retire when he retired, and his wife is 54. And I am sitting here telling him, I'm like, dude, I do not support what you're about to do. I mean, he's going to the Social Security Administration. By God, I'm going to get my Social Security benefits now because it ain't going to be there in the future. You're not convincing me otherwise. And I'm like, well, what about your wife? Because when you die, she didn't work, by the way. She's depending upon you, okay? And when you die, that Social Security check you're getting now at 62, which is a lot less than you could at age 70 for her benefit, that's what she's going to get.
And I'm assuming this guy probably didn't need the money from Social Security benefits.
He didn't. That's the more mind-blowing thing, Gary. He didn't need the money. There's no impact on the long-term probability of success of his plan, okay, if he waits to take Social Security. But if he dies early, there is a long-term impact to the probability of success of his plan. Okay.
Absolutely.
Yeah. So listen, I can lead you to water. Okay. But I can't make you drink the water. And ultimately he went down and filed Social Security, and his wife to this day, when we'll do reviews, and he'll leave to go to the restroom, and she'll say, Ryan, I wish you would have done that, to this day,
I know. You brought up our buddy Joe. I never forget, I'm doing a TV show with Joe, and our good buddy Joe is a diabetic, but Joe is the breadwinner of the family. And he's like, Gary, I'm waiting as long as I can to turn on my Social Security benefits because I know I'm going to pass away first. And I want to make sure Ange gets the higher of the benefit. And I said, Joe, that makes I was so glad when he said that, because I came back to some of my clients. Like, you are not the greatest of health, yet you're the breadwinner of the family. Let's wait as long as we can so she, or vice versa, he gets the benefit of that higher Social Security. I mean, that's what you call Social Security optimization. We're optimizing it, but you got to work with a fiduciary advisor, and you got to be willing to have those hard conversations like this guy was not willing to do with you. That you got to be open and minded enough to know that you're working with an advisor that's looking out for not only your best interest, but your family's best interest.
Well, Gary, I think we have a common thing, or something thread in common, and that is, I am not here to tell you what you want to hear. I'm here to tell you what you need to know. And sometimes what you need to know don't feel good when you hear it.
No.
Right? but
it hurts.
It
It
certainly
hurt.
can.
I mean, you taking somebody with $1 million IRA and it's like, hey, let's convert this money. Whoa. I got you. You want me to pay $250,000 in taxes? I mean, yeah, mathematically it makes sense. Now we can spread it out and I'm okay with that, but it's going to make you and your family are going to benefit greatly if we do this, especially in the long run. And we're living longer. So why would you not do it now while taxes are low? And sometimes you just got to kind of beat it into them and say, look, I promise you the math isn't lying here.
Yeah, and mathematically, we do have software and spreadsheets and all that kind of stuff to prove that to you. But Garry, it's interesting because I think some people have gotten a little lackadaisical about this stuff, and the reason why I say that is you're hearing in the news that the Trump tax cuts are permanent. Well, I got news for you. If you live 30 years in retirement, there's an election cycle every 2 years. That means you're going to go through 15 election cycles. Okay. If you live 40 years in retirement, that's 20 election cycles.
Right.
And the people who make the laws are in the Senate and the House. They're not in the White House. Okay.
That's right.
And so you are going to have a situation to where what's here today, even though it's called permanent, it ain't permanent. It's not. And there's a lot of changes that can come down the pipe. And so I think where Garry and I really come into play here, and we kind of harp on this stuff, is we believe that when an opportunity is present, we should take full advantage of it because that opportunity may not be here in the future. And my friend Becky Swamsberg, who you know over at Stonewood, she spent 25 years on the Hill lobbying for tax reduction. And she'll tell you the same thing. She's like, Ryan, I know they're calling this stuff permanent, but it's anything but.
Yeah, absolutely. My friend Bobby here, our advisor here, he goes, it's permanent until it's not. I love what he said. It's permanent until it's not. And he's 100% correct. And I don't know, Ryan, what else we can do. I mean, our TV shows, our radio shows, our podcasts that we're doing, all the social media content, we're still doing educational events and dinner events. And the number one topic is, folks, you got 4 years. You've got a 4-year opportunity that you may never see again in your whole life. And maybe you've been smart and you've already pre-planned and you've already done Roth conversions. If you have, I love you. I think you're awesome. But the majority of people still have all of their money tied up in some type of qualified or taxable account, 401ks, 403bs. That's the majority of Americans. And so I hope one or two people listen to this and go, you know what? I need to call these guys because I really need to start converting some of this money over to Roth versus traditional IRAs.
Or at least look at it, right? Because
get a second opinion.
Yeah, for sure.
Yeah, I have a commercial that says you don't get a second opinion from the guy who gave you your first opinion. I mean, a lot of advisors just, you know what, Ryan, and I don't want to beat anybody up here, but a lot of the big box stores out there, all they talk about is growth. Growth. And guess what? You've got to have growth. It's part of what we do. But are you planning? Are you income planning and healthcare planning and Medicare planning and legacy planning and tax planning? I think that's what makes us and people like Joe so different because we are really trying to look at the best picture for you all around, not just talking about growth over growth. We're talking about planning for your future. And I think that's what makes us so unique and different.
Well, I think there's a disconnect that's occurred because if you go and you see commercials, everybody's focused on performance, right? The growth.
They love
it. How did you do compared to the market last year? Okay. And the reality is, if that's what you're talking to your advisor about, your advisor is not an advisor at all. They're actually what's called an investment consultant. And they're providing you advice on risk tolerance and cost benefit analysis and how to allocate money in various investments like stocks and bonds and commodities, real estate, international equity, cash assets, and that sort of thing. That's what they're doing. And guess what, Garry? You can get that anywhere. That is a commodity in itself. Okay.
It is.
But it ends there in most cases. And the reason why it does is that's all they do is their bottom line is made by investment consulting. And their shareholders benefit from the bottom line, which is why they focus in that area more than they do advanced financial planning. When we get into
that's why they don't talk about Roth conversions a whole lot.
We'll get into that in just a second, right? But advanced planning it's wealth transfer, it's wealth protection, all right? It's tax mitigation. Those are some there's a lot of channels in those topics there, that we can really get into. That's ultimately what wealth management is. And it's a whole formula and a process that's not just picking this mutual fund and selling that stock or picking that bond. There's just so much more to it.
There is. I just shot, I don't know if you saw it or not, Ryan, I shot a short video out about, we're about to face the greatest transfer of wealth that we've ever seen. It's coming up. And my whole message, and the reason I did this is I was really trying to get to the ladies out there. It's simple reason is, stats tell us the ladies are out they're going to survive longer than us, bottom line. And I think ladies are going to be able to they're going to be taking in all this wealth over the next several years. It's going to be the greatest wealth transfer we've ever seen in America. And if you're not on top of your game with planning and tax planning and healthcare planning and income planning, all of a sudden you get all this money and you're working with the wrong advisor or the wrong firm. And all they're doing is trying to throw you in a bunch of growth stocks, which again, I love growth stocks. They're great. But what are you doing to plan? When you assume all this money, when you get this great transfer of wealth from your grandparents or your great grandparents, what are you going to do with that money to make it last forever and hopefully make it last for your kids?
Or just from husband to wife, right? So a lot of times we see the men, and I'm not in any means saying they're not powerhouse women out there that go out there and win the bread and save money and take care of things. But the majority of what we see is the men are taking charge of the finances and the retirement planning in the family. And it's important because when a man walks in my office and he comes in with a spreadsheet and slides his spreadsheet across the table to show me how well he's done, all right, I kindly take the spreadsheet, I don't even look at it, I flip it over, and I slide it right back to him and ask a question. Are you married? Yes, I am. All right. So there's a 90% chance, unless your wife is unhealthy currently, that she's going to outlive you. And here's the problem with that. She's going to be the one that is around to find out how well your financial plan does or does not work out.
That's right.
So until she's here, we're not interested in having a conversation with you.
Good for you. Good for you.
And the reason why that is, Gary, is they're going to inherit, the women are going to inherit the money from the men, and they're going to be in control of finances. And it's so important that they understand what's going on, how the plan works, what to do, what not to do. Because if they don't, what I get concerned about is the kids get involved. Yeah. All right. And the kids want to go take the money and buy crypto with it, do all this other stuff, and it can be at a great detriment to the surviving spouse.
I had a lady in Cleveland, Tennessee, right above Chattanooga here, Ryan. Now, this has been a few years ago, but she called and unfortunately her husband had walked to the mailbox at 57, 58 years old and just had a massive heart attack. Didn't survive. So I went up and met with her and I'm like, okay, so, where you guys at? What do you have? Just trying to get to know her a little bit in her situation. She goes, I have no clue. I said, what do you mean you have no clue? She goes, Gary, I don't even know where our checking account, I don't even know who our bank is. Like, I know nothing about our situation. It took me 2 years of a lot of blood, sweat, and tears to find everything this man had. I even found out he had just canceled his life insurance about 3 weeks before his death.
Oh, man.
And there was a note, just tired of paying the premium. I'm like, oh my gosh. She didn't know though. And God blessed her with this gentleman had over $1 million put back in different places, but it took us 2 years to find it all. And so her life was kind of on hold for 2 years. And I still talk to her all the time because she said, no, nobody else would have ever done that for me, Gary, because I wasn't making any money. I was just really trying to help this lady out. And God forbid it worked out, but I'm with you. Now I have met with gentlemen before by themselves. And I will say, hey, got to have the spouse here in the second meeting. You got to work as a team because I guarantee you have different thoughts and philosophies on risk levels, on income planning, on healthcare planning. We got to make sure we work this together. So I'm with you on that. I love what you do. I love that you turn it over, slide it back. I'm going to try that next time. I think that's great.
Yeah, it's helpful, Gary. It sets the stage that we really are, we'd go at another level. In fact, you don't know this, folks at home, but financial advisors have a questionnaire usually that we're going to take you through when you come in and talk to us. And that's called a fact finder. At Allied Wealth, our questions that we ask to get to know you, there's 99 of them. There's
99 questions.
99 questions. Yeah, it's a lot. And people are like, these are a lot of questions. I'm like, it is, because we want to get it right. It's important to get this stuff right for you. And these questions help guide us on getting it right. The funny thing is that a lot of the questions, Gary, are around beliefs, values, and more importantly, what do you see yourself doing in your golden years? What are you doing? Where are you? Who are you with? Where do you live? What are you doing? Where are you, right? Traveling? Are you living down at the beach?
Right.
Or you doing a cruise? And what's happening? And then we back into, how do we fund that vision, right? Utilizing the money you saved and created. And that's important. And, having both spouses involved in that process, or spouses involved in that process, is just paramount.
It's, I have a saying, I want you to live every day like a Saturday. Saturday is my favorite day of the week because I love college football. And I've always said this, every day should be a Saturday. I wake up on Saturday mornings and I am fired up in about a week and a half from now. I get so excited because I just love college
I bet you're
football.
glad Nick Saban retired too.
I am kind of glad, and I really do enjoy him on ESPN. He does a great job.
Yeah,
but I think when you retire, you should wake up every day and be happy. And what are we doing today? You can do whatever the heck you want to do if you got a good plan together. But one of you may want to travel, one of you may not. So that could be a conflict, right? But you're going to have your go-go years. You're going to be healthier as you retire, you're mentally, physically. Then you're going to slow down a little bit. So you just got to do stages of planning, whether that's you need more money the first 10 years of retirement, you need less money down the road. But again, I think a lot of things that people are forgetting about is what happens upon the first spouse's death. And I think you got to teach that to people so they make sure they're taking care of their surviving spouse.
Yeah, it's so important. But here's another one. So Christine Benz is the director of personal finance for Morningstar and has been there for years. And we all know Morningstar is the company that rates the mutual funds 1 through 5. They also do managed portfolios, which I think both of you and I use in our practices. But she has a really interesting philosophy that she's learned about. She actually wrote about it in her book. And one of the things she missed, by the way, we talked about on the podcast, was the surviving spouse conversation. And we had a long conversation about that. But one of the things that really struck me with her was it's not so much about money. It's about making a transition from being the 737 captain, like my dad is doing right now, because he just retired from United Airlines, the 737 captain. I mean, Gary, can you imagine that you go take a 500,000 pound airplane and go hurl it through the sky at over 500 miles an hour on a day-to-day basis, and that's what you do. And all of a sudden tomorrow, you just don't do that anymore?
No.
Or you've been the guy at Exxon that's been the chief engineer on one of the biggest oil rigs in the ocean, drilling oil, and all of a sudden you just don't do that anymore.
Right.
Right. Or you're the heart surgeon who's saved, lives for years, and you're gotten to a point where you want to retire, but all of a sudden you don't do that anymore. And the psychology that people go through and the emotions that they go through at arriving to that point is actually a lot of times more important what they do with that than the dollars itself.
Yeah. It's, you're just, not to toot my horn here, but you're making me think of my new book. My new book's called Retire Strong. And the whole book is based on why are you so worried about your wealth if you don't have your health? Because you're not going to be able to enjoy retirement without your health. But I really get deep into what you and I just talked about. What happens up here when you stop? Because if you just stop, and actually I did a study of a 65-year-old man that he just stops, Ryan. He comes, we call it a couch potato, just does nothing. His life expectancy is 6.5 years.
Wow.
So you work all these years, retire at 65, and you're going to pass at 71, 72 because you just want to be lazy and do nothing. You have to stay physical, but you also have to be mentally strong. You got to keep your brain working because you're going to get depressed. You're going to miss your coworkers. You're going to miss those conversations. You're going to miss flying that plane across the sky like your dad did. You're going to miss that. Even though you retired from it, you are going to miss it. Your body and your brain's going to miss it. You have got to stay strong, even working into retirement. As a matter of fact, I just sent Tristan, we do tips of the week, and I'm like, we got 21 weeks left of this year. So we're going to wait till 20 weeks next year just because easier 20. What are you going to do in those 20 weeks? How can you improve your life in the next 20 weeks? And that could be for somebody 25 or 85. It doesn't matter. But the whole goal is you've got to physically and mentally stay strong and stay on top of your game, because it's really, really fascinating to me how our brain works, and your body will start going downhill quickly if we don't keep it active.
That's a fact. If you go home and retire into the lazy boy rocking chair, that is the fastest way to poor health.
It is.
Gary, you mentioned a very important thing, because one of the greatest men of all times that I know of, and certainly one of the wealthiest men of all times that I know of, is a man named Steve Jobs. And Steve Jobs was a very, very wealthy man, and he ultimately died of cancer. And that's just living proof right there that health is wealth. And I guarantee you, Steve Jobs would have traded every dollar he had to cure that
100%.
cancer and be healthy. I promise you, right?
100%.
So we have the same philosophy at Allied Wealth, that health is wealth. And while we're on this topic for a second, let me share a quick story with you. This is interesting. So, we come across all walks of life in our practices, right? Some folks are really well prepared for retirement. Some are not so well prepared for retirement. Some are actually doing great and think they're not doing okay, right? And then some are doing not great and think they're okay, right? So we deal with all kinds of scenarios. But I had a couple come in, and they're late 50s. The wife is 56. I'm sorry, 54, and the husband just turned 59 and a half. All right. And they were about $150,000 in credit card debt. Okay. Had kids living at home, putting kids through college, just like anybody else does. They paid for a wedding, putting tuition on credit cards and that sort of thing. They were saving in their 401ks, and they'd accumulated about $1 million. All right. So they're not as behind the eight ball as they thought. Well, we went to work and on a plan for them. And the first thing that we did was took a distribution out of the husband's 401k. At 59, he was 59 and a half. He's going to pay tax on that. But we used that distribution to wipe out that credit card debt. All right. And the reason why we did that, Gary, is the average rate of interest on that credit card debt was about 25%.
Wow.
And there's nothing I can do with $150,000 to generate 25% returns. There's just not. I might be able to do it for 1 year.
Yeah,
but
exactly.
I can do it next,
yeah.
And the risk of doing that could, cut the money in half.
Right.
So what was interesting is once we did that, we had them, the credit card money was gone, right? And they were paying substantial amounts of money on this debt. It was about $10,000 a month, okay? They've now redirected that $10,000 a month, all right? They've downscaled their house. They pulled out about $300,000 in money out of their house, okay? So now they're sitting at about $1.4 million of the additional savings that they've got, okay? And now, like, Ryan, the kids are out of the house. We want to do some stuff. I'm like, you know what, guys? Based on your Social Security, based on you guys working another 5 years, okay, and based on the $1.4 million you guys have saved, your money's going to grow to be enough to support the lifestyle you guys want to live in retirement. Adding your Social Security in, you guys are fine. So guess what you could actually do right now if you wanted to? You could stop saving. The money you're saving right now, you could spend, and you could go travel more. You guys could go do more vacations now. And I actually encourage them to do that, Gary, because now their health is good. They can go travel and that sort of thing.
Right.
So when I told them to stop saving money, they were kind of freaked out by it, right? And then they're not going to stop saving money completely because they get 401k matches, obviously, with the free money there. But they are starting to really consider living more and traveling more while their health's good.
I love it.
And Gary, I think that's just an aspect of working with a good financial advisor who's a holistic planner that can walk you through the perils of feeling behind the eight ball, feeling that you're feeling like a failure because you're $150,000 in credit card debt, and simply moving some pieces around the chessboard to put you on a path to success. It's kind of cool, Gary. They came in the office, and when we had the credit card paid off, I gave them a bottle of champagne.
Nice, of course.
Just a cool experience, bud.
I love it. So I promise you, I'm not just making this up. This just happened today. Tim and Bobby were on a Zoom call with a gentleman up in Knoxville, Tennessee, and they showed me the plan they were putting together for this guy. And really the hot topic was Roth conversions. And, they basically showed him how this man's going to be able to redirect some money on $1 million, which was not his whole portfolio, but $1 million and have tax-free money down the road. I mean, like this guy was so ecstatic because his guy had never talked to him about Roth conversions at all. And little old Bobby that works here, he had a fire extinguisher when he walked in my office that he took off the wall. He goes, Gary, it's getting hot in here because we're saving people taxes, man. And we're putting fires out. And I mean, it's having a heart and a passion to actually help people and have those hard conversations. I mean, you go into this couple and saying, look, we're going to take some money out of your 401k now. We're going to pay Uncle Sam his share, and we're going to pay these credit card taxes off because in the long run, here's what the math says. And I think once people see the math, they get it. They just get it. So good for you. I think that's some awesome planning, man.
Well, I say that, Bud, because I know that there's a lot more people out there in that situation and they're looking for a lifeline. And I hope when they see this, it gives them the courage to reach out to you or me or somebody else who can really help them solve those problems because they are solvable for sure. Yeah.
And something that I know you and I both have now is people can sit in the comfort of their home on the couch. They can pop some popcorn and do all of our quizzes, do all of our calculators. I mean, how awesome are you truly ready to retire? Go take a 35 question quiz. It's going to take you 15 minutes. It's going to tell you really quick, can you retire now or can you not? You need to come in and have a conversation with us. Those are the top things that nobody else is offering is say, hey, just take this quiz. Let us see what it says. And then let's have a conversation about it. I think the retirement readiness and the reality check of retiring just in a short version quiz form is so, our people are loving it. Our people are loving it. And I love when they come in and have the conversations with us after they took the quiz because they're like, okay, how do I fix this? Yeah. I've got a problem. How do I fix this? It makes it easy for us to do our job.
Well, you mentioned earlier in the podcast, long-term care. So, and we were also talking about life insurance. So let's spend the last 10 minutes we got here or so.
Sure.
Talking about long-term care, Gary, because when I started in this industry, I guess I got it in the industry back in 2006 is when it was. It's almost 20 years now. So, we used to say that a married couple had a 1 in 2 chance, meaning a 50% chance of needing to cover the costs of long-term care or going into a facility. Today, we're saying there's a 70% chance. Now, that's over a 20-year period of career in financial services, being an advisor. What's changed? Why do you think that is?
Yeah. So it's funny you just brought that up. When I started in this industry, I sold life insurance and long-term care insurance. So actually a little over 27 years ago now, it was a 33% chance of was going to need long-term care. 33. So it's grown. And it's real simple. We're living longer. The greatest risk we all have is longevity risk. Because longevity, as our friend Tom Hinga says, longevity risk brings all the other risk into play even greater. Your income planning, your Social Security planning, your Medicare planning. And the fact that we're living longer means we got a greater opportunity to get sick. And the increase rates that we're seeing out there right now in assisted living, in nursing home care, Alzheimer's care, it's tremendous the amount of money, how much they're increasing that every year. And something that's really bothering me right now is these outrageous rate increases people are getting on their long-term care insurance. 25, 30, 40% rate increases they're offered on these pennies on the dollar for what they've paid in to get out of the policy. So long-term care is a passion of mine. It's really what got me into this business because my grandmother moved in with us with Alzheimer's. Of course, I was 13. I didn't know what it was. But when I saw what it did to our family, it just devastated our family. We went from having no money to having no money. So it was tough. But the fact is, there are so many great tools out there now where, asset-based long-term care, one of the most popular things we talk about is where if you got money in the bank sitting there doing nothing for you, we can absolutely turn that asset into a great long-term care plan. And here's the key word, if you need it. Traditional long-term care insurance, if you never use it, you lose the money. Asset-based long-term care, as long as it's structured properly, if you never use it, the money just passes to your beneficiaries. Yep. And you can get up to double or triple the benefit, which is crazy to me right now. Another thing we use is life insurance. Some of the life insurance vehicles out there, myself and Rhonda have one. We have a proper structured index universal life insurance policy. Yes, if I pass away, Rhonda gets a death benefit, but that's not why I bought it. I bought it for two reasons. One, I can pull tax-free income from it and a loan down the road. Or two, if I get sick, I have some long-term care coverage. And then one of my favorite things to talk about now, Ryan, because you have to qualify for asset-based long-term care. You still have to qualify for it. They're not so strict, but you still have to qualify for it. But even our fixed indexed annuities now. I mean, I just rewrote a policy with a company that you and I were just hanging out with not too long ago over golf. And when I explained to him that, look, if you get sick and you fell 2 ADLs, and I went through the ADLs, do you know they're going to send you this money back? No questions asked. They're just going to give you your money back. And he went, what? I went, exactly. They're going to give you the bonus. They're going to give you the credits. They're going to give you all your money back. And I really, really got specific into the ADLs. And his first name was John. I said, John, you don't have to be in a home. This is if you're at home. You know, so some of our fixed indexed annuities that we have now have benefit riders attached to them as well to help you if you get sick. So there's a lot of ways to plan for long-term care if you need it, other than just traditional long-term care insurance.
Yeah, what's happened, we talk about life insurance. Where I was going with that is the living benefits of life insurance.
Incredible.
Because most people think in order to benefit from life insurance policy, you have to die.
Right.
And there is a benefit, if you die, for sure, if your loved one's left behind, which can be used for income, estate planning, all sorts of mechanisms to use that money. But there's also living benefits. And one of the biggest living benefits out there right now is long-term care coverage, right? Yeah. The other one is tax-free income, right? You brought up the A word, right? It's usually a 4-letter word sometimes it's not. It's interesting to me because right now you've got the 22% bracket and 24% tax brackets, right? So right now we've got people that are wanting to do Roth conversions that are wealthy, and they're wanting to convert up to the 24% bracket, which I'm okay with, by the way.
Absolutely.
And so we recently had a husband and wife team come in, and the IRA money was $2 million. Okay. And these folks have another $5 million outside of IRA money.
Wow.
Okay. They've already paid tax on. All right. So it's in a brokerage account. And they want to not leave a large tax bill to their son. Okay. So we were talking about doing Roth IRA conversions and going up to the 24% rate. And the husband was like, man, I just don't know. The wife's all for it. Okay. But the husband's just like, I don't know. So I said, listen, what if we took this money that I really don't want growing at 20 or 30 or 40%? Because if it does, it only compounds the tax problem.
That's right.
Okay. What if we took this $2 million and put it into a product that might get somewhere between a 5 and 7% return, maybe over a 10-year period per year, all right, but also came with a very large upfront bonus, all right? And by the way, this product had a 22% bonus on it, and it had a fixed rate so that the account pays for the first year, and I think it was around 3%.
Right.
Okay? So we put $2 million in. These folks got a guaranteed return backed up by the claims paying ability of any insurance company we put the money with, okay, of 25%. That $2 million IRA grew by 25%.
That's incredible.
And so now what happens is we take out 10% a year and we convert that money over to Roth IRA, and we're using that bonus to pay the taxes on the conversions. And this guy hated annuities. I would never put my money into an annuity. But when I explained to him the benefits of using this bonus, he's like, well, my money's not going to grow as much. I said, we don't want your IRA money to grow anymore. You've got a tax problem. Let's mitigate the tax liability, right? We can, with your other $5 million you have over in this brokerage account, the stocks you own in that, the Microsoft, the Apple, the Google, the Tesla, all the Magnificent 7 stocks that are risky stocks to own. They're great stocks, but they're risky. Keep owning those because we've got the safety of this over here. We've got a tax plan with it. And it was kind of funny. They ultimately came back and gave them a few minutes to talk about it in the conference room. They came back and said, Ryan, we wish we would have found you many years ago.
Yeah, exactly. So that's a lot of things we're doing with our Roth conversions now. And, and usually when we open the Roth IRA, most of the time we're going to put that back in the market. I mean, because I like Roth IRA money to be risky. I mean, that's
right.
the whole goal with Roth IRAs. But to know that you've got 3, 4, 5 years worth of those taxes paid for by the insurance company, I mean, that is nice to have in your back pocket. And, some of these companies are getting some really good rates. And again, you're going to average 5, 6, 7, 8, but to get that bonus up front, put it to the fixed bucket first year and know that's guaranteed. That's going to be in your account after 1 year from now. Man, it's a no brainer. I want people to understand. I know you and I both, we have our buckets of money. An annuity is just another vehicle. And if you use the right ones, they're a beautiful vehicle. If you use the wrong ones, they're not. I know a lot of people out there will go to certain advisors. They want to put all their money in annuities, and that's just not the thing to do. You just don't do that. You need the market. You got to have the market to get sustained growth, keep up with taxes, inflation, things like that. But if you use the right annuity out there, it can be a beautiful thing for you. You just got to be educated on which one's right for you.
Well, I think what happens, Gary, and we'll close it down with this, is it's kind of like when Callie asked me to hang a picture in the hallway upstairs. Okay, so she's OCD, all right, and it's got to be perfectly measured out, got to be level as can be, and it got to be secure. Can't fall down if the kids bump into the wall or something like that, right? So I go down to the toolbox, and you got a toolbox, I know, right?
Yeah.
So I go down to the toolbox, and in that moment, I grab the screw gun, I grab a level and a tape measure and a little pencil so I can kind of mark my areas I'm gonna hang the picture in. Go upstairs, hang the picture, come back downstairs and put the tools up, and I'm done. In that moment, when I'm going in my toolbox and I'm reaching in to grab that screw gun and that level and that tape measure, am I passing over the wrenches? Am I passing over the socket set? Am I passing over the pipe wrenches and the crescent wrenches and all that stuff? And the hammer? Yeah, I am.
You don't need them.
That's not the right tool in that moment for the job. But the question I always have is, in that moment, does that make the hammer a bad tool or the wrenches a bad tool? No. It simply means that in that moment, that's not the right tool for the job.
That's right. I love it.
And I think our industry, especially the big box retail firms out there that we always talk about, they're pushing an agenda. And the agenda is anti-right tool for you and pro-right tool for them.
Right.
And oftentimes leads us down a path to where the advice we're getting may not be the best advice, and it may not be the right advice for us.
Yeah, like I said, don't get a second opinion from the guy who gave you your first opinion. I think you really need to look at someone that has all the tools at their access, which is what we have. I love being an independent advisor for that reason, because I use an analogy. It's like going to the grocery store and having 3 aisles to shop from, or having the whole store to shop from. That's what these tools are for. And there's some beautiful benefits to them now. You just got to be educated, and you got to work with a fiduciary advisor who knows how to use those tools properly.
Well, folks, that'll do it for another awesome episode of Redefine Retirement. Garry Thurman, dear friend of mine, thank you so much for being on the podcast today.
Thank you, sir. Appreciate
you, buddy. See you next time, bud. Be well.
Yes, sir, man. Thank you.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.